We continue now with take a quick look today at markets, and then we move on with our charts. Well, what you see happened was a major $100 correction on gold. Then you see gold has quite a bit recovered. At least over here you have a turnaround. And now these moving averages, the MACD, are slowly but steadily recovering. You also see that there may be a possibility of a second major leg down. Well, there may not be. Very hard to tell about gold because it is manipulated commodity. It is a political commodity. So what one's got to look is Commitment of Traders report, which comes out on late Friday night. And there see how much the commercials, which were short, were able to close out, how many contracts they were able to close out. If they were able to close out anywhere between 25 and 50,000 contracts, they have closed out sufficiently to call it a bottom. If not, then again, this is a classical example of a technical analysis where you look at open positions on the futures market, and based on the open positions, you determine where all the long liquidations have been sufficient in order to establish a meaningful bottom or not. This looks like a good bottom at this point, but hard to sell, to say. Let's try silver and take a look at what happened with silver. It had a major phenomenal collapse. You can see from 21.5 all the way to 17. That's like what? $4.5. Now the two of you guys will get next time 2 penalties each. You get $4.5 drop on a $20 basis. That's like a 20% loss. So this is what they mean by high risk of commodities. It is actually not as much high risk as high volatility on the downside. A 20% loss is a devastating loss for anybody, especially in the short term. Again, it would typically recover. That's the expectation. You'll probably see, bottoming where it occurs. It may be close to the bottom, but by all means, a 20% collapse is major, and I mean major. Let's go with oil, WTIC, see what happens there. It's more interesting. Oil is not as easy to manipulate. So oil did collapse, again, not as much. Now, what you got to understand is we're looking from 110 to 100. This is only 10%. On gold, it was 20%, and on silver was roughly, well, almost 20 on gold, and on silver was roughly 20%. So you see on silver twice the volatility as on gold and on oil. Now oil, you see the volatility is a huge drop on the way down, very extremely high volatility. Again, very move up, extremely wide-ranging day. Another wide-ranging way down. I mean, this has got to be classic manipulation where they push it on the way down, buyer comes back, they push it hard again. Now for 3 days the market is comatose. Comatose means that the longs have been kind of like shocked. They are sustaining tremendous losses. They get margin calls, they get liquidations, and then the market stabilizes and see what happens. You get a phenomenal $5 run up, and then an extra $2. We can take a look at in real time, but that's not as interesting. So what you're seeing is from 99 moves up to 107, recovers roughly $7 or $8 roughly in 2 days. So again, phenomenal volatility, 50-day holds. Again, this has been a nice correction. It will almost certainly go to test the 110 resistance. Again, it may break through, it may not break through, but so far the bullish trend is intact. You expect oil to go much higher from here. Possibly a test here might not go through. It will allow for the 50-day and 200-day to move higher to provide a stronger support. It will allow for the MACD to get back to 0. It will allow for the RSI to get back to 50 and lower, and all of these will provide a powerful support on the upside. Of course, that's good news for work and travel, right? But there's a bad news, but it's a whole different story altogether. Now let's try the USD or XCU, whichever, and see what happened is, well, you had a nice, beautiful 5-day relief rally. Right here, I was, well, this is Friday, so right here, when Monday and Tuesday, before I came here 4 days ago, everything was happy talk again on Wall Street. You know, this was, and they literally said it, happy days are here again. Credit crunch is over, Bear Stearns problem is being resolved, no more problems. The dollar is back in recovery mode. Of course, the stock market, we're going to take a look in a minute, is recovering. So suddenly it took literally 2 trading days to change the mood of the market. Now they are all happy talk, which tells me that, oh, we're nowhere near the bottom. Usually, Wall Street is remarkably gloomy on the way up, if and when you hit a real true bottom. Now, as you can see, it has recovered nicely, but in 3 trading days, it has lost pretty much all that it has gained. And now let's pull first XCU because, of course, before I walked in here, I just looked at the real time. It was 158.5. And why am I saying that? I'm saying it for that same reason that you had 158 as resistance. It was, notice, extremely overbought here, very high over here. You had 1-2 trading days, phenomenal correction. So all bulls, it's called, got whipsawed. And now you see in 1-2 days you're back to 158. And now looking at 15 minutes, almost real time, we're at 158.5. So today it is already pushing through again. So as far as I'm concerned, on the dollar, that would be called a classic bear trap. If bears set up the bulls for, it allowed them a run up of 5 days, it sucked them in the market, and now the dollar is falling. Now let's see Dow Jones Industrial Average to see how it did, and why on Tuesday there was this happy talk on Wall Street. Everything's, happy days are here again. That's how they were saying, like the 2 Johns. Well, that will be kind of like right over here. That's because from 11.8, Wall Street has recovered to 12.4. Well, the stock market is still holding up, and it's holding up nicely, a lot better than the dollar. But the point is, if the dollar isn't holding well, then, the stock market is also in trouble. Now, what can we say? Well, the 200-day is clearly downward. The 50-day is also downward. At least a relief is that now the market is above the 50-day moving average, and it is slowly recovering, but the bear market hypothesis is still intact. So what you might expect is a little bit more recovery before it resumes. Now, personally, I would even think that this was it. This was the recovery. Just like this one here, you got a nice recovery here. Lasted, I don't know, maybe 2 weeks, 2.5 weeks, short-term rally. And it suckered the bulls back in on the way down. Then you had another recovery rally and another one. It's very likely this will be of the same time. Hard to say, but this is the working hypothesis. So from here on, I'd be betting 60% chance on the way down within 1 to 3 months. In other words, resume the downward trend. What other markets do we still have? TNX. That will be the 10-year. Well, the 10-year, that's the same old picture. It has not been violated. It is moving up. Now this is going here and this is going here. So it's going to be interesting. Is this and this moving on the way down going to provide support and allow to penetrate and violate, retest this 3.3? Or is this ultimately going to break through and reverse the 50-day and ultimately this to prove the true, genuine, long-term 27-year bottom in this particular case? Again, that's the big philosophical question. The US government, the Fed, will try every single possible way to keep interest rates within the 3.3 to 4 range, to support the real estate market, to support all other markets, to support, most importantly, the stock market. So they'll try to keep it in there. The question is, will they be able to withstand the sell-off from all foreigners? China's government and other Russian government, whoever still holds all of these sovereign wealth funds, they'll be dumping, of course, these bonds at these yields and at these current inflation rates. You're getting 3.5. The government official inflation, like 4.2, 4.3. So, who's that dumb in the world to hold a 3.5? Extremely risky, that does not compensate for inflation, that carries phenomenal, not only inflation risk, but devaluation, also called currency risk, and is not even compensated at all at negative real interest rates. Well, who could be that dumb? And the answer is governments. Of course, private institutions aren't that dumb. I mean, they can figure it out. Let's move on. What do we have next, Nick? Oh, well, Nikkei, right? Let's do the Nikkei, see what these guys are doing. Are they recovering? Well, you see from last week, they had well over 12,000. We've been watching it from around here. You see, again, perfect technical here. It touched it, it collapsed all the way to 12,000. See, from 14,000 to 12,000, this is already a 20%. 20% for roughly, 3 weeks is extremely high. It is a classic collapse for a stock market. Again, 20% for silver is normal. So, one of the ways that you have to keep in mind is always you have to know upfront the natural, inherent volatility of a market in order to judge whether the fall is significant or not. 20% fall for silver is just normal. It just happens every single year. It can happen a couple of times a year. 10% fall in oil and 10% fall in, let's say, gold is perfectly within the norms. 5 to 10% is perfectly within the norm of a stock market. But you get yourself 20% drop of a stock market, that's far from normal. That's a lot. Now, you get, so 5% to 8% for a currency, even less than 5% is normal for a currency. You get 8-10% for a currency, that's way, way, way too much. So currencies have the least volatility. Then diversified portfolio of stocks or a stock index has a very small volatility. Highest volatility will be associated with commodities, and especially of all commodities, you'll get the highest for the thinly traded commodities like silver, possibly uranium, where a little bit of investment money can double the price in a matter of days, possibly hours. Alright, so what else we have? Well, you see, now it's recovering. It will be really nice from here, from 12.5 to recover to 13. Again, to go close to the 50-day moving average, just like it did here, just like it did here, just like it did here, and then keep moving on the way down. Alright, any questions, guys? Alright, so we got SSEC, that will be the Shanghai. Let's see what's going on with Shanghai. Again, this was a wild, crazy bubble. So, whoa, it's been collapsing. You know, Shanghai market, see what's been going from 5,500 to 3,500. So we're talking here from 55 to 35. That's what? Roughly 35% drop in literally 2.5 months. I mean, this, you gotta understand, on that bubble is a major crisis. We haven't felt it because the Chinese market, especially the capital market, is too isolated from the rest of the world. You don't get that many capital inflows easily into China, and you don't get that capital outflows out of China. So the contagion effects of China are somewhat less than contagion effects of, let's say, Japan or any other country. Question?
Like when the Chinese can't invest in the domestic market, the stock market, is it possible that they will invest like in US Treasury? Because I was...
When you say Chinese, you mean Joe Blow, you know, Ying Qing, or you mean the Chinese government itself? Yeah, of course, they have nothing else, so they are buying. Yes, they are invested. They have hundreds of billions of US government treasuries. Yes, they do. What's the question?
I mean, since it collapses right now, is it possible that they will buy even more?
Who are they?
The government.
Well, you got to understand, the government is not too much, and at least shouldn't be in the stock market. So, again, what they do is they manage their own currency reserves. So what happens when their stock market is irrelevant for the government, at least theoretically, at least in practice? They're more concerned with gold, with oil, with possibly other commodities. They're very concerned with the falling dollar. They're concerned with the strength of other alternative currencies like the Japanese yen, like the euro and whatnot. I mean, why would the government be concerned about the stock market? What do you mean, that they're going to start buying local stocks?
I was just reading to an article, maybe you sent it.
Okay, about what?
Despite the falling dollar, the Chinese government is buying even more right now. Right?
Yes, they got to buy it. Otherwise, the dollar is going to be falling even more. Yes, that's it. If the U.S. runs $800 billion deficit, someone's got to be buying that $800 billion deficit, like Chinese government, Russian government, and whatnot. I mean, these Arab oil exporting countries, they have to buy 800 in order for the dollar not to fall. If they buy only 700, there is a 100 deficit, the dollar has to fall to compensate for it. So the dollar's going to fall 2, 3, 5%. But if these foreigners buy only 400 and the other 4 is not financed, the dollar's got to fall a lot more. So the less they buy, the more the dollar collapses. Well, someone's got to be the sucker to be buying these. And, of course, Russians aren't the suckers because they aren't buying, and you can't make them buy for any political or other reasons. So who else is going to buy? Well, of course, some of the oil exporting countries like Saudi Arabia is buying some because they are under pressure and because it's oil money for them. So, again, if the Saudi prince loses 10% on his bonds, I mean, he's got hundreds of billions of wealth. I mean, if you have 100 billion and you lose 10 billion, you still got 90 left. No big deal, all right? So, same thing with the Chinese government. So, this is the type of logic that applies. I mean, are they losers? Yes, but the idea is why they're buying, because they still think that the benefits, whatever are outweighing the losses on their dollar holdings. This is kind of explaining. I mean, they're buying because they got to buy. Otherwise, the dollar's going to collapse a whole lot more. And they believe they don't have the interest to, to let the dollar collapse now, maybe in the future. More questions? What else do we have? Are we done with the market? Did I miss anything? We looked at currencies. We look at stock markets, bond markets. We look at commodities. I think that's good enough. Anything else, Nick?
Nothing.
Not too much. All right, let's move on to those charts here. Alright, so we're back to fundamental. Well, this is also a little bit more on the technical side. Combined open interest for major commodities. So you take oil, you take gold, you take whatnot, wheat, whatever is traded on futures exchanges. You take a look at open interest. Open interest in millions of contracts represents how much buying, or what is the open interest on the exchange. Well, you can see from 96, you can see that all the way to 2001, open interest is not going anywhere. Now, from 2001, you have a distinct trend, and from 2005, it has just skyrocketed. Well, open interest represents the sum of two things, of investment demand combined with speculative demand. So, this is what people want to buy. Again, very hard to say how much of it is non-leveraged genuine investment and how much of it is leveraged speculation. But what at least is saying is that from 3, 4 going all the way to 12, you have a 4, 5 times more investment and speculative interest than just like 3, 4, 5 months ago. Again, this is typically indicative of a long-term secular bull market, in this particular case in commodities. So this is how you make in this particular case the analysis. Oh, we're clearly having whatever interest, and clearly new fresh money is entering. Of course, it may be borrowed, leveraged, but it is entering the market, so it shows long-term strength. Once you get to see a significant trend in the reduction of open interest, then you must question the hypothesis of the long term, or you must be looking at the correction before you enter the next, third, last phase in the market. Any questions here? None. What are we having? Commodity derivatives. Again, this is the same stuff as before. You look at commodity derivatives, 96, 7, 8, all the way to 2001. Not a whole lot, and suddenly, almost doubling in 2002, tripling in 2003, quintupling in 2004, and then literally skyrocketing many times over in 2005. So what is telling you is that you have phenomenal level of derivatives, which presumes also a phenomenal level of leverage, but also means one of two things, possibly the combination of both. It means that speculators are using derivatives in order to gain leverage and leveraged exposure to commodities to profit from it. But there is the exactly opposite interpretation, which is that the government, together with the banking cartel, is using ever more leverage and derivatives with leverage to artificially suppress the commodities market. Again, it may be that the one is true, it may be that the other is true, and it is perfectly possible that both are true at the same time. That the more leverage speculators use to speculate on the profit on the high side, the more government and banking cartel Wall Street is using leverage and derivatives to suppress these commodities prices on the other side, so that they don't truly explode in prices, so that they get measured growth like 20-30% yearly, not like 100 and 200% yearly. Alright, any questions here? No. What is this? US commodity price inflation relative to US consumer price inflation. Alright, this presumes, again, this may be a little shaky because US consumer price inflation may be overreported, underreported. But you can see here is that sometimes commodities run up on the way up. I'm trying to see, can you read what's here at the bottom? What is it showing? Years?
The years.
Okay, so what's the beginning of the year? I can't really see the beginning of the year. And what's the end of the year? 18 something? 1800. And what's on the other end? 2015. So what we're looking here is at like 2 centuries of data. So what you're seeing is some small, big, and you have a major reversal. Then you have like for 50 years or so reversal. Then you have 40 years reversal. again. So you're seeing is that even within commodities and price inflation, you get secular and possibly even bigger contractive waves. So what this has got to tell you is that sometimes trends or relative prices can persist for many decades. That's a good picture of cyclical analysis. There is some text, even if we're in a long-term downtrend in commodity prices, it appears whenever you'll get to read that one. Let's move on and see. Annual Confederate inflation. What is Confederate? Anybody? Confederate? What does it mean, Confederate? Is this American University in Bulgaria or Bulgarian University in Bulgaria? What's Confederate?
It comes from Confederation.
Yes, so what does it mean?
For all the states?
Hmm?
For all the states?
Well,
The Confederate States of America.
oh, okay, so it means during the Civil War they were in two parts, right? There was the North and there was the South, and one of them was Confederates. The idea was, of course, that they were financing themselves by printing money. As simple as that. This is what all these governments do, and when they get themselves in war, it's a lot easier to actually print rather than work, produce, and tax, alright? So, what you get to see here is on the price data annual Confederate inflation rates, you get to see that as early as you get, well, 1861. I mean, that's kind of like the beginning of the Civil War, and then close to 66 or 7, the Civil War was more or less over. Again, now well, the point is that, hey, this is what you get, 12, 14, and as the war went on, you get 100%, 130, 190, 400%, 700%. You see what the point is? The point is that, hey, prices can double in a short period of time, and then double again, and then double again. Well, how much was, well, that was $1 worth back then. It was worth like, you ultimately lost 400 times its value. So, in the end, 400 of those continental dollars were worth one original dollar. So, here during this inflation, the dollar lost like 400 times of its value. Well, it had to be completely replaced. Then you have the greenbacks on the other side, but I don't want to get into that. Just going to tell you. So gold price and provided, well, based on gold price provided by whatever how they computed, this can really tell you that, hey, even in America you get hyperinflation. This was a perfect classic example of a hyperinflation where a dollar has gone, in flames, and now, don't even think, do you guys really think that these dollars that you're using today, at least when you're on work and travel, is the same original dollar? No, this is like the third, fourth dollar. Yet $3 burning in hyperinflations before that, like we've had quite a few currencies in Bulgaria burning before that, alright? Is that fairly clear? Does it make sense? Well, it should make. I mean, American government back then wasn't that different from any other government. You get yourself in war, you start printing money. This is what every single government does. Alright, so this is, in this particular case, Confederate money. So for the Confederacy in Richmond. So this is particular, you get to see again from, I'm trying to see, it's 1861. You move all the way to 1865. And you get to see here some Gettysburg and victories and losses and currency reform acts and fall of Atlanta. You get to see different events. I don't want to get into the history of that, but it gets to see, what is it? This is called, the currency was called that grayback. So we have a grayback, we have a greenback, we have Confederate dollars, price, of a gold dollar. So essentially, how many grayback dollars equal one gold dollar? And it shouldn't surprise you that originally from 1 ultimately took close to 60 to make for one gold dollar. Of course, now the interpretation is same old one is that, the gold dollar didn't change in value at all. It is that the Confederate money itself lost 20, 30 or 50 times its value, so that it took 50 to exchange for 1. Alright? Is this fairly clear? Alright, let's move on. Consumer debt outstanding. This is about the American consumer who has been considered over the last 3 or 4 years the hero of the world. You know, heroes in America are made not by actually fighting, not by sacrificing, but by consuming. The more the consumer consumes, the bigger hero it is, because it supports worldwide growth. Well, what is the basis of this heroic, consumption? Things are going bad, and yet the American consumer just keeps on consuming. Well, the answer is you get to see the debt outstanding in trillions of dollars. These are billions. So we're talking 2 trillion, 5 trillion, 7.5 trillion, 10 trillion. So what you're seeing here, somewhere in 98 or 99, you also have separately in the red underneath consumer credit. You might zoom in on that consumer credit. And the blue on top is home mortgage credit or home mortgage debt. So what you have basically seen is that to be extremely heroic, all it took was to be, to be willing to borrow your house today in order to consume today. Now, how we call this in proper English, at least back 100 years ago, it was called that you mortgage your future. So, what this is doing, home mortgage debt, you're mortgaging your future. To mortgage your future means that you consume today and you risk your future tomorrow because things might go wrong and you might lose it all. Well, the heroic consumer was based on an increase. Let's take a look at it. From roughly in 99, 5 trillion to roughly 10 trillion. Well, how much is that? That is approximately $5 trillion. Well, if it's $5 trillion, what is the US GDP about? What's
13.
13. So it was about 10 here. It was, or is about 13 over there, okay? Now, keep in mind that this is up to 04. You get to 06, it is off the chart. So, if the average is about 12, right, for example, and you get an increase of 5 in roughly 5 years, all right? So, you get a total of 5 for 5 years. You average out 1 trillion per year on a 10 trillion GDP. How much is this debt fueling GDP? How much growth it provides? 1 trillion on 10, 12 trillion basis, it provides roughly 8 to 10% growth in GDP. Is this possible? 10% growth in GDP by the heroic consumer? What's wrong with this computation? Of course, something was wrong. What did I make wrong? The computation was correct, but it was in nominal dollar terms. Yes, it allowed 10% nominal growth of GDP, but because there was inflation, 5, 6, 7%, it added or boosted real GDP by a lot less, by 10% minus the actual inflation. So it actually boosted like 4, 5, 3, 4, 5, 6% real GDP. So if GDP was reported 5%, you could pretty much say that, this additional borrowing added all of the GDP, real GDP growth of 5%. So if it was not for the heroic consumer who will recklessly mortgage his future, meaning his house, for his children, rather than, give their children free and clear house, they have nothing, they get it fully mortgaged. Of course, no intelligent child will inherit a house that has a mortgage which is higher than the value of the house, right? I mean, when the mortgage is upside down, it's a whole different story altogether. But the point is, if there was not this mortgage debt to boost, to add 3, 4, 5% real growth, US economy would have been completely stagnant at 0%. All right, is this making sense? Well, that is why this was a purely artificial, phony growth and recovery from 2001 to 2004. Because it was based on pure borrowing, and the pure borrowing contributed to all of the real growth or nominal growth in GDP. All right, does this make any sense? So that's why you cannot borrow your way to prosperity by consuming what you borrow. If you borrow, you build a factory, a machine, you put it into productive, real capacity, then it's a different story altogether. Let's move on. Alright, so consumer sentiment has been steadily dropping since December 06. Why would consumer, meaning the hero of the world, will be steadily losing confidence over time? From 2006 and throughout 2007. Why would that be?
Confidence in what?
Huh?
Confidence in what?
Consumer confidence. So, about the great, about the prospects of the future, how great we feel today and how great we feel will be 1 and 2 years from today. Now, what are the prospects, good or bad? And they felt ever gloomier about the prospects. And if you actually looked at 100%, they were felt in 1966 at 100. The consumer felt at 82, felt way worse today than 1966. You would have thought they'd be feeling a whole lot better, a whole lot richer. Well, it's a whole different story. The point is that in this particular case, because, again, this is macro, somewhat fundamental analysis, gloomier consumer must be foretelling that sooner or later the consumer will retrench and will shrink their consumption. Well, if the consumption shrinks, then, GDP, which is consumption plus investment plus G plus net export, will probably suffer tremendously. Why tremendously? Because consumption now has become 70% of GDP. So a small percentage drop in consumption cannot be offset unless you get a phenomenal increase percentage-wise in one of the other 3 components to compensate for a loss in consumption. So what this is presaging here is that from December 06, the loss of confidence throughout October 07 will almost certainly result somewhere from August to the next couple of months in a recession. If the consumer isn't buying, it is likely to be a recession. So this alone should be telling you, this consumer confidence, that with a sufficient lag, 3, 6, 9 months, you're going to get your recession, and therefore the investment implication is a nice bear market. Alright, is that connection fairly clear? Does it make sense? Well, that's the typical fundamental analysis. You look at, consumers aren't going to be spending. Probably it's going to reflect negatively on the macroeconomy. It will probably be a recession. Then the investment implication. So this is the typical logic. And of course, you want to look at 10, 20 different pictures and see if they tell similar story or different stories. All right, let's move on. So let's take a look at the heroic consumer, and it tells you consumer debt is a percentage of household debt. Well, what this particular is telling is that real estate has become a major portion throughout the 80s. You see the consumer has liquidated up to 94 a substantial portion of their mortgage debt. And now you're seeing in 2000, mortgage debt is taking off, and that's up until 2003. Now you can guess that by 2006, this number is way, way higher, much closer to 90%. So we're now having, roughly from 50% to 70% to 72%. So what we're talking here is it's gone probably way, way higher. The point here is that mortgage debt has become the predominant driver of consumer debt. So, if you're going to be looking at the consumer as a hero of the world, you know that this hero is, driven by debt. Now, what this tells you is that the consumer's debt is driven mostly by mortgages. So all you might do is zoom in analytically on the mortgage market, analyze it, see what the mortgage market is telling you, and then you can extend the trend to consumer debt overall, and from there to consumer consumption overall, and from there to the macroeconomy. Is that much chain of reaction clear? Chain of logic? Does it make sense? So as the mortgage market goes, so does the American consumer. Let's move on. Alright, so this is the chart I was kind of like talking a few minutes ago, is that consumption has been from 52 all the way to 1982 within the 60-63% range. So, extremely tight, narrow range all the way to 82. Well, you got to understand that once you, to consumption, once you add government expenditures, the rest must be savings. So, if you're getting a steady increase in consumption, given that government is not offsetting by lower government deficits, it must be that the savings rate is steadily falling. Well, you have 1982 as this bottoming point of 62%, and it has gone up to 71%, and it's gone even a little higher in 2004 and 5. What this is telling you is that personal consumption has become a extremely important factor, 71% of the whole economy. So, again, before there was more leeway. If the consumer retrenches, you had other sectors to pick up. Well, now the consumer has become a whole lot more of the economy. Growing from 60% to 72%, that's like 15-20% more. So the share of the consumer has grown a lot more. So now the US economy is a lot more dependent on the consumer than ever since 1952, and probably ever since the beginning of meaningful economic time in America. Is this fairly clear? Does it make sense? All right? Any questions? Now, you all know. Well, you guys got to tell me when it's time to go, okay? Let's move on. What is this weekly? Copper prices. Oh, okay. This is big talk now that there is a wild bubble in copper. And the biggest proponent of this in the world has been Frank Van der Rosso. He's a legendary guy in the investment world. He has one of the most stellar reputations. Yet he's connected to central banks. He's done a lot of central bank research. So, as long as someone works for central banks, you got to understand and expect certain biases. Nevertheless, he has claimed phenomenal speculative buying of copper. I'm talking about 2006 and especially 2007. And he has claimed that this is a true, genuine, classic bubble. Well, again, I haven't seen Bulgarians buying copper and, stashing it in the basement or under the bed, right? So it doesn't feel like a bubble to me yet. But, again, his argument was, hey, it will not be realistic to run up from 150 all the way to 4 in a matter of, 1 year. Now, what he's claiming is, well, the price is actually manipulated. Evil speculators are buying up all the copper, removing it from the market, withholding supply and withholding inventories, making the market artificially tight, and because it's relatively inelastic, the price skyrockets, and if the price skyrockets, evil speculators profit tremendously at the expense of good, honest, businessmen, you know, kind of like users of copper. So this would make the prices of houses more expensive than anything else that uses copper. Well, what are we looking now? We're looking here at a major correction, but still a trend line is forming. We're looking at another run-up, testing but not quite. A second run-up, testing but not quite. A third run-up, testing but not quite. And still you have the long-term trend. As far as I'm concerned, I personally don't think it is copper because very few in America actually invest in copper. Well, he's claiming only that evil hedge funds are doing it, right? And when it comes to, well, why would evil hedge funds do it? If I am the monetary authority of China, which is managing the reserves, I'd be greedily buying at 350, 400, everything I can buy. I just put it on storage and leave it there for 10 or 20 or 50 years. Worst case scenario, it's just going to be backing the currency. I mean, you had back in the old days, gold backing the currency, making it convertible to gold. You had it back in the old days, making the currency convertible to, let's say, silver. What's wrong with backing it with copper? You know, if they are willing to sell it, hey, I'm on China, I'd be buying it. Well, Veneroso in his research simply says, well, it's not likely that the Chinese are buying simply because they say they're not. This is way too, as far as I'm concerned, especially for a central banker, you know, it's extremely naive. I mean, it's childish to say, oh, they're not buying because they said they aren't. Of course they're going to say they are not. I mean, if you are the biggest buyer in the world, you got to be dumb to even admit that you're buying something. You know, the minute you admit, oh yeah, we're buying copper, what does it mean? Russian speculators and European speculators, Japanese speculators, everybody's going to rush to front-run the Chinese authority. They're going to drive the price sky high to 10 or 20, 10, you know, 5, 10 times even higher, trying to sell it extremely expensive to the Chinese government. I mean, if you are a big player, you never ever want to admit whether you're buying so that they don't buy in front of you and drive up your price, or that you're selling so that they liquidate in front of you. I mean, that's plain stupid. No one does it except central banks when they announce sales of gold, right? Why? Why would they want to announce the sale of gold? Well, to allow all speculators to sell and to get speculators to do their dirty work of manipulating and smashing the price of gold a lot lower, because that's what they want. They are not selling gold to make money or profit out of it or get the best price. They're selling it to manipulate the price lower. So they announce to the world once, and then a second time, and then a third time, and then they say, and yes, we're going to sell tomorrow. Go ahead and sell before us, so that everybody else sells before they sell, so as to get everybody to liquidate their positions. So, no large player in the world, except for central banks selling gold, will ever announce their, you know, major moves. Of course, if you are SAMA, what is SAMA? S-A-M-A? Saudi Arabia Monetary Authority. This is the institution that manages the currency reserves of Saudi Arabia. Of course you're going to be buying big time. King Saud is planning to build 2 or 3 new cities. Each would be worth tens, probably hundreds of billions of dollars. He will need all the copper in the world just to build those cities. I mean, how much copper it takes to build, you know, cities of millions of people? Well, an awful lot. If I'd be the king of Saud, I'd be just saying, buy all the copper, as long as it's 4 or under 4, just keep buying it all and don't care about it. We got the money, we'd better spend it on copper than on US government bonds. The the copper will hold its value and very likely rise, and the bond will actually fall. And again, it's just dismissive tone. Well, they're not really buying because they say they're not. Well, that's a little bit too primitive as far as I'm concerned. But again, it may be, it may not be. As far as I'm concerned, in order to get a true speculative mania, you need the little guy. You need all the little people that were buying dot-coms. I mean, you got to understand, 99% of U.S. investments during 1999 were buying dot-coms and telecoms, like dogs.com or pets.com or dogfood.com, you know. All the stupid dot-coms that, you know, Wall Street was fielding them, they were devouring it and didn't have enough of it. Well, again, once you get to see all of these common ordinary people buying and stocking up on copper, only then you can call it a true genuine bubble. So as far as I'm concerned, we don't have a bubble in copper, but then again, you know, the guy spends a lot of time to say that there is. I mean, if he spends 40 pages to justify it, he either has some inherent interest in it, or maybe he's right. Again, that's highly controversial. China's big appetite. Well, this is one of those charts which says, well, soaring demand for copper from China could keep prices high even as the U.S. economy falters. And this is consumption of copper in China. So, this is one of the classic counter-arguments against Venerosa. Now, you two girls are getting 1 penalty each, and if not, you're going to be getting 2 penalties for her, okay? So, let's move on. So, China's big appetite, you see that there has been steady rising demand, meaning consumption coming from China. Alright, so maybe that demand is genuine, maybe that demand is steady, maybe it is real, okay? And so maybe it's not just a bubble. They just want to use it. I mean, these Chinese don't want to live in those shacks made out of some stuff. They want to have real water coming in copper, or whatever pipes. They want to have electricity. If you're having Chinese villages for the first time you put electricity, it better be with copper. Copper's got a great electric conductivity. Okay, let's move on. Corporate borrowing do you know what is this SAAR? Anybody? Seasonally adjusted annual rates. So usually they will adjust for January effect, for December effect, or whatnot. And you see what corporations do. What corporations do is that they dramatically lower their borrowing during a recession. You had one here and borrowing went down. You had in 73 another, borrowing went down. You had a 79, another one, borrowing went down. 80, 82, you had another one, borrowing went down. 90, you had another major drop-off. And then had in 99 another major drop-off. But also, here's corporate borrowing. You see how it's going up, 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 up. And over to 2005, 2006, you got to understand, corporate borrowing has skyrocketed. And if and when a recession comes, it has got to be the case that all of this borrowing will evaporate, and then what will sustain corporate America is not clear. The sustenance will be on prayer. All right. So let's move on. The cost of things as in commodities, has been high. I have borrowed this from Jim Spoplava's website, Financial Sense. It's a very nice thing to see from, let's say, late 2001. Oil has bottomed roughly 15, has moved up all the way to almost 45 in a matter of 2 years. Crude oil has roughly almost tripled. You look at natural gas, it was like $2. It has gone up all the way to 8 or 9. Currently is about 10. So from here, 2002 till today, natural gas has more or less increased roughly, 5 times. You get gold, same story, you know, it has doubled more or less here. It has gone more or less 4 times. You get copper. Copper was roughly 60 or 50. It has more or less, doubled here. Just on the previous chart you saw, from 1.3, it's gone up all the way to 4. CRB is the general commodity index, which includes, let's say, 15 commodities. Again, same story. It has almost, not quite, but almost doubles. Platinum is another nice indicator, from roughly 400, go all the way to 900. If you would remember, recently it went over 2,000. So all commodities are going up, and he's just showing you this for 3 years. Let's move on. Countrywide Assets. All right. Who is Countrywide? Well, what's the correct question? Come on, guys. Huh?
Which countries included?
No. The correct question is, who was Countrywide? Countrywide went bankrupt, guys. It doesn't exist anymore. This was the poster boy of mortgage lending. This was the greatest mortgage lender in America. It was symbolic of the real estate. They were the smartest of them all. They were also the most creative. They were the ones that were inventing all of these exotic mortgages with no down payment, variable arm, and no doc, and all of this great stuff. I mean, when it comes to true, genuine, let's call it inventiveness, they were the best of the best in America. Well, they were also, of course, the most aggressive in America. Well, let's see how exactly. Well, from 100 billion roughly to 200 billion roughly, they literally doubled their assets in, this is already 04. So to September 07, in 3.5 years. I mean, do you guys realize the phenomenal level of aggressiveness? If you're going to be doubling your assets in 3.5 years, I mean, this means that these guys have gone on a mad, crazy credit binge. In this case, it's going to be credit lending binge, if they're going to maintain these growth rates. Well, what is growing or has been growing the most? Well, this area here, I don't know. It's got to be loans held, this one in here, right? And what you're seeing is that they have expanded their portfolio mostly by expanding their loans held. So, where was Countrywide? Well, Countrywide was not too long ago went bankrupt. It was bailed out once, it was bailed out twice. It borrowed 60 billion from FHLB, this is Federal Home Loan Banking System, just to tide it over until it was merged with one of the banking giants. Because if Countrywide collapsed with that kind of size of assets, it would have guaranteed the complete meltdown of the whole US financial system. So it was not allowed to be. So again, what is it? Let's move on though. Let's move on. Countrywide liabilities and equities. Now, you were looking at what they were, what assets they were holding. Now you're looking here at what were their liabilities. In other words, how did they finance themselves? What did they use for growth? Well, they used for growth deposits. And if they are deposits, they're considered to be short-term or demand deposits. So, from tiny little deposit base, over here, they used well over from 150 to 200. So, they had like 50 billion of deposits. Well, what does it mean if you're having 50 billion deposits? Well, you expose yourself to a classic bank run. Well, Was there a bank run in Countrywide? Yes, of course, there was. There was a major, well, that's how it collapsed in one day. You know, you had all the people rushing, not too different from Northern Rock. There was a classic bank run. And how did the media know about it? Well, Countrywide was very popular in California, and it was very popular in the LA areas. So, journalists passing by saw what is it, the star of music, the rap star, that was waiting on the line to get his money. The rap star had a couple of million deposited in Countrywide, and he was eager to get his couple of million before, while they had some money, because otherwise his deposit insurance covers only 100,000. You get a rap star there, and 10 minutes later, guess what? You get 100 journalists, and you get a whole bunch with the cameras. So suddenly, everyone's interested. What the heck is a rap star, superstar doing in a line with a bunch of other guys, waiting in front of Countrywide? And he's saying, oh, I'm taking my, of course, presumably he's of color with extremely low education. Oh, I'm just taking my money back because the bank might not be there tomorrow. So I want to get it out before everybody else gets it out. And guess what? This is in real time on TV. And you see this rap star and, a big line of customers on TV that he's afraid of getting his money out. And then the journalist says, reassuringly, all the other 100 people confirm that they're also, waiting on their, to get their money. And what do you think happens? 1 hour later, you have thousands of SMSs and emails flying around all across America. The Countrywide, might be bankrupt, so you better go and get your money while you can, because tomorrow you might not. Well, that's all it takes, just a couple of hours, and then that's the end of it. So they had to borrow, blah, 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 and whatnot. But how else did they finance themselves? So you have deposits, they had securities sold. Well, they also had notes payable. Well, you got to understand about notes is that typically in finance, when you say note, you distinctly mean short-term notes. So in finance, when you say the word note, you imply that it's a short-term debt. And when you say bond, you typically imply that it's a long-term debt. Similarly for government bonds and for government notes and for government treasuries. Well, Countrywide was playing the boldest of all games in banking, and that is they borrowed short and lent long, okay? So borrowing short and lending long has two problems with it. Number one is it works beautifully as long as interest rates go down. When interest rates inverse on the way up, you blow up. I mean, this is how 99% of all banks in the world go bankrupt. Because they borrowed short, lent long, and when interest rates went up on them, they went bankrupt. I mean, that's what, classical bankruptcies are. But the second problem is you borrow short and lend long, you are exposed to a bank run. Creditors might say, no more lending. They withdraw their deposits, and you are, because you lent long, you can't collect immediately. You have very little liquid cash. You are exposed to a bank run. So they basically did all the classic things which are done during credit booms, which maximizes profits, is you borrow as short as possible and lend as long. And when the trend reverses, you're the first one to go bankrupt. And so they did. All right, let's move on. Annual consumer inflation. Okay, this is shadow government stats. It is basically telling you if you had, you had it computed as it was back in the old days, and then you see how much the government has introduced according to shadow government statistics and according to Bureau of Labor statistics, and you get to see that the gulf has to open ever wider. So what this is telling you that from 4, which is what the government tells you, shadow stats sees an inflation of 10, more real inflation, if you use government's own methodology during the early 80s and late 90s. So a true inflation of 10% is what it's supposed to be. Again, you don't have to believe in the one, and you don't have to believe in the other. This is not a course in religion. You have to be aware that there is the one, you have to be aware that there is the other, you have to be aware that there is a gap, and you choose what you want to choose. Well, how do you guys choose? Well, for you it's a little bit easier. You've been out for roughly 1 year from the US, I mean work and travel, you're going to go back a year from now. You go back and watch yourself. Are the prices that you're seeing 1 year later 4% higher, as the government says, or actually 10% higher? So you should be alert, observing by yourself, and decide which seems to be more realistic. Is this good enough for today?
Yes.
You want to go home? Alright, so we're done for today.